Well, thank you very much for those kind words, and it is a huge pleasure to be here this evening. And I've already had a very interesting time talking to students, staff, and local businesses at the various points I've been to this afternoon. Most of my remarks will be about economic policy. It will be about the state of the economy. It will be about the prospects for the economy. That is what I've spent most of my life doing. In the course of that, of course, I have experienced many recessions, and I'm going to describe some of those experiences this afternoon. I think we're all aware by now that the recent downturn has been particularly long and testing for many companies, and particularly, of course, for the banks. And what I think has also become enormously important is adaptability has been crucial to succeed in this type of environment. The signs are that the economy is turning the corner for the better. I think as some of the financial and international headwinds have been easing, although it is important to recognise that output in the UK is still below the level that it was before the recession started. It's also important, and one of the things I want to address this evening is to be aware of some of the origins of the credit crunch, because this is critical for banks and how they adapt to the new regulatory environment and how it is that they learn the lessons of how we got into this position in the first place. I'm going to make only one plug for Santander in my remarks this evening, and that is to say that Santander has been able to weather this storm better than most other banks, and in my view that is for two reasons. First, it maintains and always has maintained a very cautious approach to risk, and it operates a very healthy balance sheet. The second is that the management team was able to respond very swiftly to the economic conditions that emerged in the aftermath of the financial crisis. And one of the themes that will emerge, I hope, later is that in a situation where one can never really tell the future and what it is that's going to happen, how one responds to those type of events becomes enormously important. Now, as I said, this is the fourth recession I have worked through, and some of them I have, as the Vice-Chancellor mentioned, been at quite close quarters. At times, they've all been very grim and equally uncertain. And what I want to do is to begin by trying to make a stab of drawing out some of the general lessons about those experiences to provide some kind of context for the challenges we face today. So I'm going to say a little bit about each of the three earlier recessions and try to identify some of the similarities and differences, and then I'm going to discuss the extent to which the present recession, how it compares with earlier recessions. As has already been mentioned, I first set foot in Manchester just over 51 years ago when I came from my home in Durham to the University of Manchester to study politics and modern history. And in my first year, I had to take a course in economics and discovered for me the subject that has come to dominate all of my working life. When I graduated in 1965, I went to London as a research assistant following my tutor at Manchester University, Jim Ball, who had just been appointed Professor of Economics at what was the brand new London Business School. And we were there more or less at the first day that the London Business School opened its doors, which coincided, of course, with when the Manchester Business School also started. Working as a research assistant at that stage, my main task was to help my boss to develop an econometric model of the UK economy, trying to use it to make forecasts of how the economy might develop and to simulate the impact of important changes in government policy. We ended up publishing forecasts based upon this model in the Sunday Times business section from 1966 onwards for 3 times a year, and I did this until the end of 1979 or so. And unlike today, in those days there were very few forecasts that were published, and they did receive quite a lot of coverage. So that is how I spent really quite a lot of years. And the first recession, therefore, that I experienced was 1973 to 1976. And what's important, I think, is to recognise that this was an occasion, and we'll hear this at a later stage in some subsequent periods, experiences. It followed a long period of relative stability. In the post-war years, sometimes the economy, when the economy was going well, it was growing at 3.5%. In a bad year, it was growing at 1.5%. Harold Wilson used to talk about stop, go, but I think by the standards that we know today, they were little more than wobbles. And if you think that the present circumstances are uncertain and complex, I just want to remind you of some of the events that led up to that first recession that I worked through. First of all, this was a time, in fact, when there were enormous amounts of protests that were taking place. We had 1968, we had anti-American riots in Grosvenor Square against the Vietnam War. There were protests in many parts of Europe, including the Prague Spring. 1969, widespread student protests. And for example, there was even a temporary closure of the London School of Economics as these protests went on. Another critical feature of the time, and of course we see it echoed today, was that Japan was beginning to emerge as a major player in the world economy, and by 1972, commodity prices were rising very rapidly. The whole post-war system of fixed exchange rates was creaking as the capacity of the US to retain its link with the price of gold came under question. And in 1971, it abandoned that link. The UK had its very first post-war housing boom in 1972, and we moved to a floating exchange rate. We had prices and incomes policies, which I may say had a combination of these events led to a whole succession of strikes by the miners and the utility industries. Power blackouts in the winter were a normal part of the scene. And I was sitting in my office there in London with this very tiny early computer trying to run forecasts using this model that we had produced, where every 2 or 3 hours the electricity would go off and the whole thing would bomb out, and I had to start the process all over again. And in fact, all of that wasn't enough. By the autumn of 1973, we had the Arab-Israeli War, and by Christmas, the oil price had gone from $4 a barrel to $12 a barrel. And by the end of 1973, of course, most of the UK was on a 3-day week. And those were the circumstances that led into that very sharp first recession. Output peaked in the middle of 1973. It then fell quite sharply. The bottom of the recession was reached in mid-75. And it was only at the end of 1976 that we got back to the 1973 level of output. And by 1975, inflation was running at 25% a year. Now, can you imagine what living in that environment was like? What it did, of course, was to put huge pressure on public spending, and tax collection fell. The budget deficit soared, and by the autumn of 1976, we ended up going to the IMF for help, as well as introducing a major program of cuts in public expenditure. So, as I said earlier, you think that today things are particularly difficult. One of the things that all forecasters say, well, there are two things that all forecasters say. One is that the outlook is particularly uncertain today, and the other is that the whole background is particularly difficult. One of the things I will try to show you is that, in fact, this is a common theme that runs through all of these type of events. Another of the features that comes out of this, I think, is that after one of these recessions, there is actually quite a significant shift in conventional wisdom, and I hope we'll see that in a moment in some of the other periods. Now, when I look back, from what's almost 40 years ago, I would say that one of the important contributing features to the problems that we were having at that time was that we were trying to continue to run the economy the same way that it had been after the war, in a way that was trying to disguise or was trying to overcome the extent to which the UK was becoming uncompetitive in the world economy. And so we were trying things like devaluation, fiscal expansion, support for declining industries, incomes policies, etc. And this, of course, was a particular problem for manufacturing companies who were faced with the huge competition from Japan and other Southeast Asian countries. And as we emerged from the recession, I think it became increasingly recognized that that whole period of post-war controls was over. We had to recognize the increased importance of Japan and the Middle East oil producers. A new framework for policy was necessary, and that was really the beginning of something which, of course, has lasted for quite a long time, which was moving towards floating exchange rates, having much more active monetary policy, and this great emphasis upon fiscal discipline, of course, which we hear a great deal about today. Now, I then spent that was the first, and it was really difficult to describe for those, of course, who weren't around, but I mean, it was a very, very severe experience, that in the mid-70s. And I then spent the next 5 years trying to adapt this model of the economy that we had been constructing to try and encompass the events of the early 70s and to try to create a framework that helped us understand some of the things that had been happening. However, then my life changed because in the autumn of 1979, Geoffrey Howe, who was then the Chancellor of the Exchequer, asked me to become the Chief Economic Advisor to the Treasury and to exchange what was my London Business School model for the Treasury model. I found myself at the age of 35 in what was effectively the second level in the Treasury, working closely with people who were 20 years older with me. It was very exciting. However, it also turned out to be the eve of the second great post-war recession, more or less as I arrived. And this one lasted from 79 through to 82, and in many ways was the second phase of the 73 to 76 recession. And again, we had an oil price shock and higher inflation around the world, and the second oil price shock came in the wake of the Iranian Revolution and the fall of the Shah. And by 1980, when the Iran-Iraq war had started, oil prices were $40 a barrel. And if you remember, I said only 7 years earlier they had been $3 a barrel. And of course, this had tumultuous effect upon the world economy. And the new Thatcher government, and quickly followed by the Reagan government, tried to take decisive action to deal with the inflation by aggressive monetary policies, and it meant very high interest rates. And I joined the Treasury more or less as all of this was beginning to bite, and we went through another one of those rounds of increases in taxation and cuts in public spending. This time output fell from the peak to the low point by some 6%, and it took until the first half of 1983 until we got back to the 1979 level. And, we talk about political unpopularity today because of cuts in public expenditure. This was the main agenda issues on current affairs programs throughout that period. However, the government persevered with their policy of tight monetary and fiscal policy and eventually got inflation back down to about 5%. I think it also it concentrated the mind. The other thing that had strengthened in our minds by then, of course, was that the UK really did have a serious underlying problem with the competitiveness of the economy. And at that stage, the government set forth on one of these programs of deregulation and privatization to try and improve what had become known as the supply side of the economy. Running repairs. I don't know how many microphones I'm going to end up with.
This one's live on Sky.
And that, after that experience, although it was a very difficult one, there were actually something like 8 years of good growth, low inflation, increased productivity growth, and a significant improvement in the performance of the UK compared to other countries. However, the third recession came in 2001, and that coincided more or less exactly when I became permanent secretary to the Treasury. So each time I change my job, it seems to have a rather bad impact. And this recession started in mid-90. It followed this very long period of what seemed like a period of steady growth, and that had emerged into a really quite significant boom in 1988-89, particularly in the housing market, followed by a sharp correction. There had been a real estate boom actually in the US and in the UK during that period, and then we had another war. By then we had Iraq invaded Kuwait in the August of 1990. We had what was known as the Gulf War, and once again we had a very sharp increase in oil prices. Recession set in, output fell by about 3% to the bottom, compounded by a new event, of course then, which was some complications with the European monetary system. And the background to that was that the European monetary system people had in their mind had actually worked quite well in Europe, and yet we were having trouble in the UK with the conduct of monetary policy. And Europe wanted to set forth on the notion of a common currency. Now, whereas there was no real appetite in the UK for joining a common currency, there were people in government who wanted a stronger link to the euro. There was a huge, ferocious debate in government, and I was working very closely with the people concerned. Nigel Lawson, Geoffrey Howe, both resigned over the issue effectively. And then eventually the decision was made to join the exchange rate mechanism in September 1990. And this one happened to coincide almost exactly with the aftermath of the fall of the Berlin Wall in November 1989 and the unification of Germany, which took place in October. And it was one of these most remarkable sort of tensions in policy, because we happened to join a system just at the moment when Germany, which was the linchpin of this system, who normally had very low interest rates, happened to be going through a period of very high interest rates because they wanted to try to prevent the overheating as a result of the unification. And so we found ourselves in a position where we wanted to get interest rates down below German levels because we had a recession, and it wasn't possible effectively to do that. And every time we tried to do it, it started a lot of speculation. And this ended up with the huge and terrible problem of the forced entry out of the ERM, or Black Wednesday, as it came to be known. That led to a huge amount of political bruising. But I think looking back on it, it is possible to make the case that it was the process of going into the ERM which actually finally did get our inflation back down to very low levels. And it was also the occasion when we put in place an alternative policy, which was inflation targeting, giving the Bank of England much more independence over how they conducted that policy, having a much more transparent and open way of doing it. And basically, those decisions have been at the core of the conduct of monetary policy since. Now, Gordon Brown, of course, completed the process by making the Bank of England independent in 1997, but actually the policy was more or less that which had been set up in 1992. And what followed was 15 years, of course, of extraordinarily steady growth combined with low and stable inflation. And I guess that is the world that most of you knew before the next terrible crisis occurred. But looking back on this, what I wanted to do is to try and draw some generalizations from the experience and to see what it was that they had in common. And it's obviously clear from my narrative that recessions do have different origins, they have different characteristics. But looking back, there are some recurring themes. And I think both the 73-76 recession and the 1992 recession followed a period of growing over-optimism about the underlying growth of the economy. Long periods of good performance, in my experience, tend to be a terrible trap. It's very easy to accept good news. It's very easy to take your eye off the ball, and governments are no less prone to that than the rest of us. Second point is that the ends of these periods of the sustained growth, there usually were various warning signals that were emerging that all was not well, and this was particularly the case with commodity prices and oil prices, house prices and some other financial assets. But there is a terrible tendency to explain, in those periods when you think you're going through this great new period and you've cracked all the problems, you tend to say, well, the bad news have all got particular explanations which don't really tell us anything other than that they are particular. And of course, this is one of the other things that tends to distract attention. And I think what I've also tried to mention is that even this kind of combination of events can be turned into a full-scale recession by the combination of a number of external political and market events. And oil prices and wars have each time been quite important factors in the timing of recessions. I'm not saying they were the cause of them, but in terms of what actually then produces the trigger, I think you can say they did play a part. The other feature that comes out of it is that for the UK, the recessions are not short episodes. It tends to take some time from the peak of output down to the low point, and actually quite a long time before you get back to the starting point. I reckon that the downswing has typically lasted 8 quarters, and it takes another 6 quarters or so to regain the previous peak in output. And that, by the standards certainly of the United States, in terms of cycles, are quite long ones. And that's worth bearing in mind when we look at the present recession. It's also, I think, looking back, very difficult to judge the likely pace of recovery from recessions. And my observation, having been a forecaster, is that almost all forecasters are over-influenced by recent experience, whether it's good times or bad times. And following the 3 recessions I have described, one of the quite significant features is that forecasters generally understated the pace of recovery once eventually it did get underway. All of the recessions ended up with budget deficits for the government and had to be corrected by tax increases or cuts in public expenditure. And the other feature that I notice is that at the end of each of them, there actually was quite a significant shift in orthodoxy about how economic policy should be conducted. So after the 75-76 recession, we had the move towards monetary and fiscal control. After the 81-82 recession, we had the emphasis on privatization and deregulation. And the end of the 91-92 recession saw the shift to inflation targeting and much more transparency about the conduct of the Bank of England and of giving them more independence in terms of how they conducted those policies. And I think each of those strains were there, and of course, as we see, some of those strains are present in the 4th recession, because that is the one that we have been living through. Now, this time, rather than being a forecaster or being in the Treasury, this time I have been watching this through the eyes of being chairman of Santander UK. And the first point to mention, of course, which I've hinted at, is that this recession came after 15 years of really very stable growth and low inflation. There really was a growing optimism that we had developed a framework to avoid booms and busts. And there was a lot of confidence about that. However, what we then find is by August 2007, not only were we in the early stage of an extraordinary credit crunch, but the problems which started in August 2007 ended up with queues outside Northern Rock. 12 months later, in the middle of September 2008, Lehman Brothers were bankrupt. Output peaked in the first quarter of 2008, and it fell very sharply by something like 6 or 7% over the course of the following 18 months. And now we are 6 years on, and since that peak in output, and the latest figures we have for the 3rd quarter of 2013 show the GDP is still 2 to 3% short of that level. So this has been a recovery, and this has been a cycle which has been even longer than the 3 previous ones I mentioned to you. However, I think there are some similarities with the previous recessions. Once again, it comes at the end of a position of great optimism. It coincided almost exactly with the 10th anniversary of giving the Bank of England independence over monetary policy. And even in the sort of summer of 2007, I would go to conferences where people would say that this major innovation had transformed the economy so that output growth was not only higher, but it was more stable than ever. Inflation was more stable than ever. And indeed, I think people used to talk about stability everywhere. And this is more or less on the eve of the beginning of the recession. I think you can also say, of course, that there were quite a lot of telltale signs of problems that had already started to emerge. There was a housing boom, commodity and oil price increases were strong. We had seen this huge expansion of financial activity. And yet, the official view, thank goodness I was no longer part of this, was that the potential growth rate of the UK economy had now risen, and we were in for another, for a really glorious period. The other thing, of course, where I think there are similarities with the previous recessions is now it was the so-called BRIC countries, in particular China, who were beginning to take a major share of world economic activity and were really impacting upon performance of the rest of us. Now, so those are some similarities, but there have also been some quite important differences from the earlier recessions. The first one is that this recession, and it's almost unique in this, was a recession which was not preceded by an increase in inflation. Largely, I suspect, because the deflationary effects of lower import prices from China and Brazil, etc., who were competing very heavily in terms of price. But the biggest difference is probably about the way the recession came to an end. It's not so much how it's created, but the way it came to an end. And as I say, normally what happens in a recession is that inflation rises, interest rates go up, and this then creates the recession, which takes place until the point at which inflation comes down and interest rates can then come down to a more normal level. But this time the boom was brought to an end by the emergence of bad debts, an abrupt freezing of the interbank market, and huge losses on financial securities. I mean, it was a banking crisis. And what happened was that those losses inflicted severe damage on the capital resources of many of the banks. They were forced to cut back on their lending to avoid being too dependent on wholesale markets. And instead of high interest rates, which affecting lending, which was the normal pattern, what we had was lending being affected simply because the capital position of the banks and the bad lending of the banks was having a big impact on their ability to lend. And the question, of course, arises: why did we get it so wrong in the lead up to 2007, given that we had recessions previously? Well, I've already mentioned this problem about overconfidence, which is created by a long period of success. But I think what also happened was that we came to believe that developments in financial management techniques and globalization had actually given us the opportunity to expand lending whilst spreading risk. The view was, fair enough, there is enormous expansion of lending, but it was really believed by, I'd say, the economics industry, the finance industry in general, that because much of this had been securitized, because much of it had been spread around the world, that we had managed to both increase lending and to reduce risk, which of course was a sort of philosopher's stone of finance if it was possible. And this was a mistake, as it now turns out. It was made by individuals, by regulators, and by governments. The era of low interest rates, of course, had made more lending affordable, asset prices had continued to rise, and we'd had, what now you can see much more clearly was many years of credit-fueled growth. Now, as the economy then moved into contraction because of the banking crisis, all parts of the economy began to try to reduce their leverage. Individuals, companies, governments, and the banking sector all wanted to get down the ratio of their debts to their income. But of course, as activity fell, the amount of public sector indebtedness increased, and that has had a huge effect upon some countries who needed to get down their budget deficits. Until something like the second half of 2010, the pattern of the recession actually looked reasonably close to the experience of the 1980s. The falling output had come to an end during the second half of 2009, more or less as in the previous episodes I described. We then had 1 year of reasonable recovery, but then this was followed by a year of very modest growth, and indeed a further year of relative stagnation. And it became quite clear that there were still very severe headwinds that were in the economy. And I think those headwinds fall into two categories. One was the continuing effects of the credit crunch. And this is the stifling effects of the continuing distortion of financial markets, the pressure on banks to reduce their reliance on wholesale markets, the losses on financial instruments held by banks, the pressures by the regulators for the banks to raise the amount of capital which they held and to shrink the risks that they were seen to be running. And all of this really compounded this problem of and the ability of banks to lend. And the second really strong headwind that emerged, of course, was the pressure upon the sovereign debt position of many of the Euro countries, particularly what being called the periphery countries, who were the countries who it was seen a loss of competitiveness relative to Germany, and who had very large budget deficits emerged. And there was, of course, a great uncertainty about the sustainability of the euro and whether or not the countries concerned could take the action that was going to be needed. And this, of course, was, it's been a very painful process. That I think there is some evidence now, looking back, that in fact recessions which are created by financial dislocation do tend to be slower to recover than those recessions which are caused by inflation. But I don't think anybody was quite ready for the length of time that this one was going to last. However, since the beginning of this year, I think we have seen distinct signs that the headwinds are easing, and we're seeing improvements in both business and consumer confidence. One turning point in London in the summer of 2012 was when the president of the ECB said he stood ready to do whatever was necessary to keep the Eurozone together, and since then, the markets in some of the troubled countries have improved a lot. Banks have also made a lot of progress in writing off their bad loans and raising their capital ratios, so they're now in a much better position to begin to resume lending. And we're also well on the way to implementing a new framework for liquidity management, and what's something that the regulators are very keen on is having methods of crisis resolution mechanisms. And in the UK, we actually had a government funding for lending scheme, which probably didn't have the effect that many hoped it would have, which was to suddenly cause large increases in lending. But what it did do was to actually bring our market interest rates down much nearer to base rate, and it did in turn make it possible for banks begin to get into a rather better position. Now, I think in the UK we are seeing a substantial impact on the confidence for both companies and individuals. The housing market is clearly showing signs of returning to normal, and what everybody is now hoping, of course, is that we're going to have a period of a virtuous cycle where house prices and other asset prices stabilise, the pressure on banks eases, economic activity expands because banks start to lend rather more, and with that recovery, government finances look a lot better. And this, of course, would take quite a lot of pressure off the austerity agenda, and of course the Eurozone would also be in a position, if the same happened there, to see greater confidence. Now, I think it's quite important at this stage that we both welcome the signs of recovery, and we welcome a return to, there's some important return to normality, but I don't think anybody can say that they know how the timing of this is actually going to work out, and whether we are really in a position where it is going to be like previous recoveries. And I would argue that it is important that we continue to remain ready for a range of outcomes, but I think in my mind there's no doubt that we're in a much, much better position than we were 12 months ago. I mentioned earlier that one of the features about these recovery phases is that, or post-recession phases I should say, is that you get this sort of feeling that we can't go back to business as usual, and that there have to be some changes in policy. We have to be willing to address other options. And of course this time that focus of attention has been on banking supervision and regulation, something I experience every day, and also senior executive remuneration, something else I've got to deal with most of the time. That the questions are also being asked about, the whole approach to economic policy, about income distribution, about the role of public services in the economy. And already there are on the banking side, some quite big changes that have taken place. Capital requirements on banks have been multiplied by a factor of somewhere between 3 and 5 times, which vastly increases their capacity to absorb losses in a crisis. We now have backstop leverage ratios. We have a crisis resolution mechanism in place to manage difficult situations in an orderly manner, so that if banks fail, so banks in a sense can fail when necessary, whilst minimizing the impact on the banking system or upon society as a whole. We're seeing steps in the European Union towards a banking union as a means of trying to restore trust in the euro and to reduce what had become a vicious circle between sovereign risk and banking risk. And I think we are seeing a good deal more activism now by shareholders about salary levels and regulatory restrictions on the payment of cash bonuses. And those are, I think, the beginnings of some of those things, as I say, that you hear, this must never happen again, and the beginning of wanting to make quite important changes in the way in which financial services works. I'd also just like to develop a point I made earlier about the world environment. I think this has been another one of those periods when we have seen a really very major change in terms of different parts of the world. And I think one of the defining characteristics of this last few years has been the increasing importance of the emerging countries, Brazil, Russia, India, China, etc., by comparison with the mature industrial economies. And they've been doing much better than the mature economies. However, it's very easy to become too gloomy about this and see this simply in terms of a loss of jobs. Because what we're also seeing in these BRIC countries is, of course, the emergence of a growing middle class with consequential demand for food, energy and manufactured goods, but also for important services, whether it's banking, education, health or communications, and indeed I would add broadcasting to that with my other hat on. And adjusting to this changing world, I think, is much more important, and indeed it's much more complicated than simply wanting to turn back the clock. The world has moved on. There is a different distribution of wealth. Countries are growing very rapidly in parts of the world that were not growing rapidly. And this is going to have both major competitive problems for us, but at the same time, major opportunities. I also like to make the point, of course, that the triggers for these crises, as I've tried to argue, are often the combination of a number of what we describe as low probability, high impact events. But when we look more closely, I think what we can also see is that the events themselves easily show up some of the problems and weaknesses in assumptions that we have been making about how the world works. And managing through these problems, it seems to me, is one of the things that is critical, is that we have an open mind, that we have a willingness to question how these events are going to impact our own businesses, that we have to be prepared to re-examine quite a lot of things that we've taken for granted and contemplate wider opportunities. And this is where those people succeed, or those who manage to take the lead in thinking about what the dislocation means for their businesses and how it is that you take advantage of the weakness of others. And I know I, in general, conclude by saying that one of, I think, the most important lessons that I have learned living through all of these experiences, and in different capacities I know that I have been working, is that the range of possible outcomes, both going into recessions and coming out of recessions, is much wider than you can ever imagine at the time. Now, I started life doing modelling and analysis, and I still believe that there is a lot to be gained from modelling and analysis, and that the process of following through scenarios, engaging in stress testing of plans, they're all very important disciplines, and they're things that we should be doing every day. But I think it is also important, and it's crucial, not to be too rigid in thinking about the possible range of outcomes. And what I have been struck with time and time again is that the real damage to the plans and expectations or forecasts that I have been involved in either making or in trying to make work are things that have been caused by these low probability, high impact events, which are enormously difficult to anticipate. Thank you all very much.
Lord Burns, that was fascinating. Lord Burns has agreed to take a few questions. We don't have terribly much time, so try and keep your questions brief.
Well, I've got to catch the 5 to 8 train. That's
somewhere south of what we've got, perhaps. But when you ask your question, wait for a microphone to find its way to you. I have two rather attractive young assistants who are going to bring a microphone.
You're not allowed to say that, by the way.
Sorry? And tell us who you are when you ask the question. Does anyone have a question?
Thank you. G.D. Lewis, PhD student.
Hello.
With the business school. Thank you for this very interesting presentation. You mentioned a number of changes that have taken place in terms of policy after each recession. One of the most recent ones was the decision to separate monetary policy from financial stability sometime in the 2000s, and then recently the central bank has been vested with new powers. Do you think that's a good thing, bad thing? Should it have been done earlier? Your perspective.
Okay, well, what happened was that when the Bank of England were given independence over the setting of monetary policy in 1997, the decision was made to take away banking supervision from the Bank of England and to set up the Financial Services Authority. Now, I was working very closely with Gordon Brown at the time that those decisions were made, and I mean, all I can say is that there was a huge debate about moving banking supervision away from the Bank of England at that point. But the view was taken that if the banking supervision was left with the Bank of England and they were independent in terms of monetary policy, that the Bank of England would become too strong for a body that was an unelected body. However, what then has subsequently come to be believed, of course, is that setting up the Financial Services Authority and actually not having the Bank of England as closely involved was itself a terrible mistake. And so what we have now got is the move back to putting half of what the Financial Services Authority was doing back into the Bank of England, which is the prudential side of the supervision. But they've left the financial conduct part it's been put into a new regulator called the Financial Conduct Authority. I think there has been a general move back to having supervision of banks done by central banks. It's not to say that their record when they were doing it was particularly good. We had bank failures here when banking supervision was being done by the Bank of England. But I think what we did learn is that when you find yourself at the height of a crisis, when there are banks that may need to be rescued, when you need a mechanism for rescuing them, when you have to be able, in a sense, to put as much money into them as is necessary in order to give the confidence of the customers that it will be all right, there actually is no substitute for the central bank in terms of carrying out that job. And I think that is the reality. But it is scarred on me, that whole period, because Eddie George, who was the governor of the Bank of England in 1997, who was a very close friend of mine, said he would resign if this went ahead. And I was the piggy in the middle, really. I was the person who had to do the negotiation between Gordon Brown and Eddie George over that. Well, we kept Eddie in his job. He came to believe, actually, that it was a bit of a relief that he didn't have to do banking supervision anymore. And there was always a worry that that a failure of a bank can actually cause quite a lot of reputational damage to a central bank. But I think the general view now is that the 1997 decision to remove it was a mistake in terms of what I've described here as those low probability, high impact events. For day-to-day supervision, it was fine being somewhere else. But when you suddenly come across one of those events that you had not expected, you had not anticipated, you actually need a body which is in command of the marketplace, which has its hands on the printing presses, and it can really solve the problem and remove the crisis of confidence.
Thank you. Amanda, I think you were going to ask something.
Yes, thank you. Amanda Broderick, Dean of Business School. One of the legacies of the financial crisis is a 5% drop in productivity in the UK. Seeing as this room is filled with the next generation of business leaders, do you have any top tips for managing through this?
Well, you can say that it's one of the consequences has been a 5% drop in productivity, and in a strict sense of the word, this is true. But what you can also say is that employment didn't fall as fast as output fell. And this is one of the debates that is really going on in economics now as to why this happened. Is it that we have a measurement problem? Is it that we're not measuring output correctly in a service economy? Is it because people were expecting recovery and therefore didn't want to lay off workers if they thought they were going to have to rehire them? Is it because they managed to keep earnings levels down and therefore were able to afford to hang on to their employees? These are the things that are all up for debate. Now, I suspect that part of what has happened is that there is a measurement problem. I also suspect that part of what is, and particularly in financial services, in services generally, the service economy. Because, if I'll take Santander, if demand for using our branches falls because people start using the internet or whatever, we don't move immediately to reduce people from the branch. What happens is that the queues are shorter, and actually the quality of the service that people have goes up. Now, how do you measure that? Do you just measure it in terms of transactions, or do you measure it in terms of transactions and the service quality of what it is that people are experiencing? And measuring service, it used to be easy to measure what was happening in the economy when you had real things, things that you made. Measuring output in services is enormously difficult, and I think the more we have become a service economy, the more difficult it is to be. The only other point I'd say is that this is not unconnected, of course, to this debate about the living wage. All of a sudden we're now saying, well, living standards haven't gone up as much as we expected. But actually, I suspect that one of the reasons that we actually have more people in employment than anybody would have expected, given how far output fell, has been because wages have adjusted and because everybody has shared the burden, really, of this, rather than just seeing a large increase in unemployment, which is what's happened, for example, in Spain. In Spain, huge increase in unemployment, particularly amongst young people, whereas we've had a slightly better record on it. But I think in 10 years' time, we should come back to this in 10 years' time, because then we'll have some more statistics and possibly better statistics. And then we will find out whether it has gone down. But this is the UK employment market is the employment market in this country remains, I think, hugely competitive, but also very worthwhile for the reasons I talked about in terms of the opportunities that now exist in so many of the industries, like the whole media city that we see here. Is a transformation of our economy. It's a very different type of work. It's a very different kind of competition. It has very different opportunities in terms of the overseas market. And what we should be, I'm much more interested in keeping as many people in jobs as possible, rather than these methods, some of these measures of productivity.
Thank you. I think last question, the cheap seats.
Hello, Laurie Perrins. I'm a staff member here at the University of Salford. And thank you very much for a very interesting and inspiring talk about managing through difficult times. The university sector is managing through difficult times at the moment, so partnerships such as this are very valuable to us. And my question touches on the philosophy and thinking behind the Santander University's concept. A business like Santander could choose many good causes to invest money in. You invest an awful lot of money in the higher education sector. Why do you think it's important for a business like Santander to invest in higher education?
Well, when this program started, I think you've got to see this in the context of the Iberia, Spain, Portugal, and some of the other countries in which Santander have been operating, where there were not the numbers of people engaged in higher education as there are in the UK. And there was very important, very deep belief that if those countries were to prosper, if they were to grow, if they were to become competitive in a world market, you needed people with skills. And that this was, that there was no better thing to do if you were going to look at your social investment program than that the social investment program should be in terms of people. And that has been the driving force behind it. It is also, it turns out, something that really does travel, this whole idea. And, Santander sets itself up as a global bank. It is a global bank. Santander has more branches in the world than any other bank. I mean, partly because of the countries in which it operates. It does entirely retail banking. In other words, it is dealing with people and with small companies. Most of the, I mean, there are some large company activity, but there is no wholesale banking of the time. And it was, it was genuinely seen as a way in which you could really engage with the communities that you were investing in. And the fact that you could have one policy, in a sense, one scheme that you can roll out across the whole world, because everybody is interested in higher education. And I went to Brazil not long ago at a Santander meeting, and it's a very young bank. The people who work in our bank in Brazil, it's a very big bank, but they're all very young. They work very hard from sort of 7:30, 8 o'clock in the morning until 5 o'clock at night, and then in the evening they go to university to get their qualifications. And supporting that kind of activity is a very important part of what I did mention in my talk. It's about the whole issue about growing the middle class. I mean, not what we call the middle class, but what, in a sense, the Americans describe as the middle class. Of getting people into banking, getting them into education, getting them into things like insurance and financial services is all part of the way, and healthcare, of course, of leveraging the economy. And universities are a very important vehicle in doing all of that. So this is, this is now, this is very much in the heart of the company and the bank. It is not. This is not a, it is not just an add-on. It's not something here today, gone tomorrow. I mean, this is something that is very big as far as the whole group is concerned.
Thank you very much.